Yo, what's going on, guys? I hope you're all doing well. Luke here from ZCFX Trading as always. So in this video, we're going to be discussing specifically supply and demand chains. Now, supply and demand chains is very important because obviously it's going to help you locate valid POIs in which where you should be looking to enter the the markets from, and yeah, it can just provide some nice high probability setups. Obviously, you can go ahead and pair it with a high time frame, session characteristics, age of run, daily cycle, the sweeps, whatever. There's so many things you can tie it in with to sort of create a higher probability setup. But first things first, what I'm going to do is I'm just going to show you the textbook example, and then we'll go on the charts and show you that as well. So as you can see here up on the screen, we have a left side on a bearish trend and the right side bullish trend. Like I said, this is a textbook example. It's just to help explain the logic or the thought process behind it. So as you can see on the bearish trend on the left side of the screen, you can see here that we have price mitigated supply zone, breaks bearish to the downside, enters into a new bearish range, and then just repeats the process multiple times. Then vice versa on the bullish trend, mitigates the demand zone, breaks into a new bullish range, comes back down, mitigates a newly formed demand zone, right? But if you look at something in common which they all have, the zones, even though it's still textbook and lines, it won't be anything like this in the markets, don't get me wrong. But if you look at the zones, it's all within the same sort of region, right? And that's where the mitigations are coming from. And as we know, obviously the price moves up and down because the BFIs are constantly mitigating in and out of their orders. They can't just go ahead and place like a a billion or like 1,000 lots on the EU, for example, right? But they can go ahead and place like $1 billion into the markets. They have to do it in small increments because they can't upset the markets too much. If you understand the order blocks and things like that, you'll understand supply and demand chains, right? As you can see, they're all in the same region. So what I'll do is I'll just jump onto the chart and just show the real life example, as that would be the best thing to do. Now, as you can see up here, right, just jumping straight into it. We do have a bearish truck here. We came back down, mitigate this extreme supply. Obviously, we don't have any chain of any form of chain at this point, but then we do break straight to the downside here. We come back up and mitigate this zone, and obviously, if you look at the previous mitigation, it's still within the same sort of area. Okay, that's what we're looking for. And then from there, price came back down. We eventually broke structure here, and we didn't pull back into this zone, but I can explain why we didn't pull back into that zone. But it's important that you have ideally two zones in situations like this, and you'll see it here on the M15 later on as well. So make sure if you keep this little picture in mind, you'll see it on the M15 too. Now, as you can see here, we came back down, we wicked this low. Now this is not a breaking structure at this point, okay? We only really view bodies as closures on H4 specifically. Well, when I say we, I just say we at ZCFX, and most of the community members as well who follow my way. Now, as you can see here, we wicked it, we came back up, obviously we violated this internal demand zone, we came back up, mitigated it, so obviously on this side is now a supply zone, and then we break straight to the downside, we have a new bearish range, we come back up, mitigate this supply zone because obviously the previous mitigation was here. Now obviously this isn't always going to be 100%, for example, if price mitigates here, it could still come back higher and mitigate something within here, but it doesn't matter. What matters is that we are, when we see an opportunity line up. For example, if we dump to M15 and there's no reaction here, then there's the likelihood of price heading higher and topping into this next available supply is obviously going to be much greater if there's no reaction in within here. But as there's reaction in within here, the previous mitigations here, we just continue this potential supply chain, and obviously from there, this is all internal structure. We do break structure here, and then mitigate this zone again, going based off the previous supply demand chain, or where the supply chain. We come back up, we break structure here, so we break structure here, we come back up, mitigate this supply, and just continue the process, you get the idea, right? Just a bunch of supply zones everywhere, but it's all within the same region. That's exactly what a supply chain is, and obviously if you were to flip that, that's exactly what a demand chain is, and you see them quite all the time. Obviously now we've spoken about it, you probably see it more as you're more consciously aware, but you will start to see this play out in the markets quite a lot. Now, obviously, just a quick rule of thumb as well. Obviously, even if you didn't have all these, breaking structures or chocks and things like that marked, it's still important to trade supply and demand, like in terms of who's in control, right? So, for example, at this point, at this point, or at this point, or at this point, or at this point, or at this point, there is zero reason why you should be looking to buy in the lower time frame from that point, because we are still within inside of this H4 bearish range. So price war is going to continue higher. we would need to see the supply get taken out. And then obviously, you know, a change in hands to demand, then obviously we should start to see demand being respected, right? So it's a lot better way to trade in terms of waiting for chart POS, etc. You're looking at the flow and you're asking yourself who's in control, and you're trading based off that, okay? That's very important. But going back to this, as you can see here, supply, we came back up, mitigate this zone, and then we dropped to the M15, and I'll do that in a minute and show you the trade entry, which I was going to discuss, that was on about familiar. But again, just going back to this, we want to be reacting, not trying to predict what's going to happen next, okay? We can anticipate certain moves. For example, if we're in sales from here, we're going to be anticipating that we are going to take out this low, because that's what the overall sentiment is telling us, right? Now, if you're at this point and you'll be looking to buy, obviously it doesn't make any sense to be, you know, really looking to buy from there, because we are tapping into a high time frame supply, and you're just trying to predict what's going to happen next, right? You may get lucky in the odd, you know, one every now and then chance, but the ideology still stays the same. You shouldn't be trying to predict what's going to happen next, okay? We can start to, you know, anticipate longs playing out in the markets once we do take out the supply, but as we are within this supply at this point, there is zero reason to be going to long, and that's what a lot of people do. They get caught up on the wrong side of the market, and just knowing that little simple thing, you know, just not trying to predict, but trading what you see, okay? Not trying to trade what you think is going to happen, or what you know, like I say, think, or, you know, predict the same thing, right? Rather than you trying to predict the next move, just react to what the market's doing and trade what you see, right? Right now we're seeing a bearish range, a supply zone. At this point, why would buys cross my mind? They shouldn't be crossing my mind, okay? But that's just the message I wanted to spread as well, is because a lot of people, they will constantly try and predict, you know, think of what's going to happen next, when in reality they should be, you know, just reacting to what the market's telling them, okay? So trade what you see, not what you think. Very, very important. Now, obviously from there, what we can do go ahead and do is drop to M15, and that's exactly what we will do. Now, like I said, you can pair it in with other things like the Asia session, you know, liquidity, daily cycle, things like that, and that can be, you know, create high probability setups. Also, I wanted to just quickly discuss as well the way that we trade inside of ZCFX. We can refine, you know, certain zones. For example, if you look at this zone here, you can say that, okay, well, we can refine the M15 inside of the H4. That's completely fine, by the way. So for example, if you look within here, we have a supply mitigation there. We also have another supply mitigation here, and we also have another supply mitigation here, right? If that's, I'll just draw it within zones because it'll be probably a lot easier, to be honest. Okay. Obviously you do have that supply chain off that as well, so you can go ahead and drop to the M15 from this zone, as it's in a drop to the M1, sorry, off this M15 zone, okay? That's completely fine. However, we're not going to be discussing that today, refinement and things like that. We're just going to go based on what we're seeing. So as you can see here, obviously, you know, you can go ahead and take an M1 entry off the M15 zone there, and there was an entry on the M1 as well. It was a very nice entry, very textbook, very ZCFX textbook setup. But as you can see here, if you go on the M15, we chock bearish. And now at this point, it's very important because a lot of people, you know, they'll obviously just mark out this POI and wait for a pullback into that POI, or they will look at a breaker, but they'll do it wrong in the sense of they won't include this as the pullback, because you got to think on the lower time frame, the wick on the higher time frame there is going to be a pullback on the higher time frame, on the lower time frame, right? So if you see a bit of price action like this, and then there's a wick here, that's going to be a big pullback on the lower time frame, okay? So a lot of people invalidate this and still look at this as, you know, where they should be traded from. For example, they'll say, okay, price will come up to this breaker and fill this imbalance here because that's where the imbalance is, okay? But in reality, this here is fine for a pullback into the zone, okay? And you'll see it a bit more clearer here on the M1 as we jump onto the M1 now. But you can see it here a bit more clearer, right? We broke below this zone, we pulled back and then started to form another M1 supply chain. But before I just jump onto the M1, I just want to quickly discuss something here on the M15. So as you can see, right, at this point, you usually probably only have one POI, which is all the way up here. But obviously from now, we just discussed, we're going to be looking at this breaker as well, right? This is, if you look on this side of the market, this is with the start of the imbalance. This is a bit of a big zone. Obviously we can go ahead and, you know, take that as one big zone, but it's very big, so I'm not going to go ahead and do that. So I'll just start it off from there, right? Because that's the open of the imbalance before on this side of the market anyways. But as you can see here, we've got two POIs to play from. We've got this POI. Let's just ignore all of this afterwards. Just only focus on the break. But as you can see, we've got one POI and one POI. So the ideal scenario is obviously to see, okay, we'll drop to the M1 off here, drop to the M1 off here and see how price reacts, okay? But obviously as we reacted to this zone, that's a pullback on the lower time frame, which we've just seen. As you can see here, we pulled back into this area. You could argue that it may get something within here. Let's break them, and then from there we formed the supply chain. You know, breaker structure, nice, very very clean entry off there. If you wanted to take a sell off there, then that's something you can go ahead and do because, well, it's very textbook, right? Then in terms of targets will remain the same no matter what entry. Even if you didn't take that entry, there are still more entries in which we will discuss. But in terms of targets, that is the target in where we want to be entering because that's the overall high time frame low. Okay, as we're trading with a high time frame, we have the high time frame intention in mind. So it's very important that we obviously, you know, trading with a high time frame. Okay. But obviously, if you didn't want to enter from there, that's fine. There's more entries to enter from. We then have the supply zone. I probably wouldn't have entered there personally because it wasn't like a, you know, we didn't break out the low and then pull back. However, we broke out this low eventually, and then we just have this zone, which I just, you know, which was fine from there, but that's where I find a bit too much. So, you know, going from there is fine for me. Even if you go off from here, like the start of the imbalance, that's fine. You can still take an entry from there. So there's many ways you can approach it in terms of how you draw up your zones, but the sort of ideology behind it is that, you know, this is the rough area in which we should be looking at supply zones because this is the region where the mitigations are coming from here right now on the lower time frame, right? So that's where we want to be entering from. And then obviously from there, regardless of how you drew up this zone, we also have this zone from here, okay? So price up into this, broke again to the downside, and then come mitigate this, and then the bearish move happened, okay? So regardless of where you entered from, whether it is, you know, up here or somewhere within here or within here, this ideology sticks. Right, we still be looking to, you know, you can, it doesn't have to be the most perfectly drawn zone. You can, you know, it doesn't have to be look perfect, right? Nothing's perfect. It can just be like a bit of a, you know, messy looking zone like that. And then obviously, as long as you have your stops in a safe place, like if you're looking to enter anywhere within this region, as long as your stops are above here or even going safer above here, you're going to be fine. Okay, it's just about the entry. You may have a little bit of drawdown, but either way, as long as you're entering within this sort of supply chain region, that's all that matters, okay? Like I said, take an entry here, here, or here, or here, it doesn't matter. That's for you to figure out. But in terms of the supply demand chains, that's how it all sort of works. It's just a bunch of, you know, if we just quickly go over it now, you can see here that we have the potential demand chain, price taps into it, comes back up, break structure, okay? Comes back up, we have a, you know, even could be a breaker at this point, mitigates the breaker, then break structure again, comes back down, mitigates the demand zone, break structure again, we have a potential zone there, we also have a potential zone here, may even come back and mitigate this and then respect it, and then we have a potential new zone, or may even, you know, come back down lower, tap into this, whatever, right? So it can do many things, but the old sort of ideology is that, you know, where the mitigations are coming from is where you want to be sort of ideally trading from. So if you've seen a previous mitigation around here, then it's probably good to look within this sort of, you know, region to be looking to buy from again, if that makes sense, okay? And that's exactly what the supply and demand chain is. If you can, you know, really focus on that and sort of try and figure out, like I said, where the mitigations are coming from, that will really help you in terms of, you know, catching nice entries. And, you know, don't try and opt in for big stop loss, small stop losses to try and get the biggest risk reward. You know, if you want to just try and have a nice, well, I discussed this the other day as well, and I posted it on Instagram. And someone asked me, what should I aim for each month? I said somewhere between 3 to 6% is still considered amazing, because if you look at 6% a month, if you were to achieve that consistently, which is very achievable in which the way we trade, if you were to achieve 6% every month and on the same brokerage account, and you're compounding the account, you know, up in the risk in terms of the monetary value of things. So for example, the 1% risk of a 100k account is going to be 1k, and obviously once you make that, 5% on that 100k account, it goes up to 105k. You're going to have a new obviously the 1% risk can remain the same, but the monetary value is going to be different, right? That's the power of compounding. So if you compound that account, aiming for 6% each month over a 12-month period, that will amount to just over 100%, right? Never mind 24 months, 48 months, 36 months, whatever, or years. But if you were to trade consistently 6% a month, even more or less sometimes, you will come out at the end of the year with around somewhere 100%. Okay, so it doesn't seem like much in the short term, but in the long run, with the power of compounding, honestly, the possibilities are endless. But just going quickly brief to this again, supply and demand chains are very important. It's just you're trying to look at where the market and mitigations are coming from, right? And you're just trading within that same sort of region. And yeah, that's how you can sort of create high probability setups. And what I will do as well is I'll post this recap down on YouTube with the screenshot, and I'll probably link it below in the YouTube description somewhere. So make sure you go ahead and check that out for the breakdown. But obviously once you see it, you don't unsee it, and it's going to be pretty much everywhere within the markets. But with that being said, anyways guys, hope you enjoyed this video. Any questions, you already know what to do, and I'll catch you on the next one.